Hello, everybody. So obviously, a lot of stock that I cover or that I've covered in the past on this channel have reported their earnings this past week, and it's impossible to cover them all. There's too many. But today, I want to focus on fintechs that are cheap. 3 of them. So the 3 stocks I want to cover today briefly, and they just reporting their Q1s. That will be Nubank, that will be, of course, Klarna and SEZL. So Klarna and SEZL are BNPL, and so some people want to dismiss BNPL right away as, kind of like an heresy of a financial system, and one should never touch those. I understand you can skip those if you don't like that. But as far as one stock where I don't understand the drop is Nubank. I don't understand what is going on with Nubank. This stock is trading as a basket with SoFi, with fintechs like slash bank-ish type stock, and of course the rates are going up, and so the market is like, oh, rates going up equals less demand for loans because rates are going up. Rates are going up equals bad for the economy, equals more default, and the market is just not looking at the revenue growth, absolutely not looking at the execution of this team at Nubank. I cannot understand the drop since March. I can't understand. Like, this stock was, 15, 16 bucks, 17 bucks for quite a while. It makes absolutely no sense that it dropped to 12 bucks. It's trading at a 0.22, so about as cheap as SoFi. Remember, they're now trading neck and neck with SoFi. And they're growing very fast. Revenue growth is 31%. Look at this. EV over forward revenue is 2.5, right? EV over forward EBITDA, trading 12-month EBITDA, not forward, trading 12-month EBITDA is a 7.8. EV over forward gross profit is a 5.11. This company's gross profit is essentially the EBITDA margin. We are very, very, very close. And this is a company that has a tremendous growth runway. So first of all, if you look at the net income growth, you can see this is unabated. If you look at their monetization revenue per customer, it's unabated. The growth in customer count is also unabated. They're getting more and more efficient every year that goes on. They have a replicable model which they launched in Brazil, which they are now launching in many other countries, but the bigger country for them, of course, is going to be Mexico. They're doing very well in Mexico, and Mexico is a huge market for them. They can use the learnings that they had in Brazil, and you can see this is their take of different banking products in Brazil. You can see, of course, the purple here being what they've taken over in Brazil. You can see they just started in Mexico. Mexico has a tremendous growth runway for them, and the product mix, the loan mix is getting better. Like, the portfolio of loans is getting better. They're having a greater share of secured loans. They're diversifying the loans. They are taking the provisions the right way. I don't understand why this stock dropped, aside from perhaps the market being scared about interest rates. And not to mention, this stock is entering the U.S. It's going after the Latin community in the U.S., which is huge. They're entering the U.S. So I don't understand why it's so cheap. This stock has been too cheap for far too long, like so many growth stocks. Capital has left so many innovative stocks, and it had barely gotten in those, by the way, and it's taken that capital and it's put it into AI. And so you have AI trading at nosebleed valuations for some of the smaller AI plays, right? Not NVIDIA, but some of the smaller AI plays are trading at nosebleed valuation. And then you have these stocks who, quite frankly, EV over EBITDA of a 7, that's the ratio I would expect from a mall going out of business. Not from a super lean fintech who's taking over old banking establishment. I wouldn't expect this valuation for Nubank. So I don't understand. It's just too cheap. It's way, way too cheap. These stocks should trade at a premium. They're highly innovative. They are the business models of the future. Of course, banking is moving to an app on your phone. That's so obvious to me. But the market is full of TradFi analysts who just don't look at the future and ignore the future, discount the future, and put an emphasis on prior performance and past performance and ignore the disruption that is going to come for a lot of these banks. Lots of disruption coming. Moving on to BNPL, buy now, pay later. Of course, Klarna is still way down, roughly down 75% from when it IPO'd. And I don't understand why. Because Klarna, I would argue, is as famous as a firm. Like it's probably the same level of fame as a firm in the BNPL space. It's BNPL, of course. You have to believe in BNPL. Do you like BNPL, right? That's the question to ask. A lot of customers, a lot of younger customers love BNPL because they have predictability. They know it's every 2 weeks. They get the money taken out of their account every 2 weeks. And they like the zero interest rates or sometimes a lower interest rates if it's not a sponsored, paying 4 or paying 5. Sometimes it's not sponsored. But when it's not sponsored, it's actually a very low interest rate. A lot of companies, a lot of retailers, instead of spending a bunch of money on marketing expense, they just want to sponsor buy now, pay later loans. And they use platforms like Klarna, where customers can pay in 4, pay in 5, and customers are loving this system. They're loving this setup. It's much easier to sell an item that's like $150 when you pay in 4 than to sell it for $150 straight. And of course, I would argue the credit card companies, they are responsible for the rise of BNPL because a lot of younger people have grown to really dislike credit card companies and to not use credit card companies. Like they hate credit cards with a passion. With a passion. That's why they use BNPL. And so when I look at the growth numbers of BNPL, whether you like it or not, this business grew 44% year over year. GMV up 33% year over year. They're also recruiting more customers, plus 21% year over year more customers. 119 million active customers. Think about that. That's a lot of people. These are large tech platforms, large tech companies, 119 million people. That's a lot of people who have used that product. That product is a hit with Gen Z. And it's growing 44% top line. EBITDA margin is 16%. Gross margin is 48%. Analysts are saying it's going to grow 26% next year. And here's the valuation, 0.05. The market is entirely discounting BNPL innovation. EV over adjusted EBITDA trailing 12 months is a 4. EV over forward revenue is a 0.5. So this is a company, of course, that is probably in Q2 or in Q3 about to post like actual EPS profitability. Like this is operating leverage in the making. This company is going to show some profitability in the quarters ahead. And then the market maybe will wake up to it. But the markets somehow, and of course you understand that. I mean, Wall Street analysts, what are they going to say about BNPL? They're going to say it's unreasonable. They're going to say it's a past. I mean, there's almost a direct conflict of interest. You work for a bank. Your bank makes a bunch of money from a credit card division. You may not like the BNPL business. Now, of course, that's not what I'm saying, but they do. Actually, if I want to be more specific about Klarna, there was an account, the way Klarna records the loan, the way Klarna records profits is not liked by the analysts, and the CEO actually created a whole video trying to explain the accounting to the analyst and trying to explain how it works. It will take time for the analyst to actually understand this company. And they do slightly different accounting from, say, the firms or the Sezzles of the world. But nonetheless, I mean, to me, the stock is way too cheap. It suffers perhaps from just being a new stock. It's been listed for less than a year. But it makes no sense at 0.05, knowing that it's one of the leading BNPLs out there along with a firm, right? And interestingly, their enterprise value is only $2 billion. Isn't that quite interesting? I would argue that's quite interesting. Actually, there is a smaller player, a much smaller player, but much more expensively valued. This is 4x EBITDA. You can see Sezzle is trading at 11 times EBITDA. That's Sezzle. That player is Sezzle. Now, Sezzle, $480 million in revenue versus $3 billion in revenue for Klarna. Sezzle is the smaller but faster growing player. And Sezzle, of course, is a Minnesota-based buy now, pay later company. Has seen some success with a very niche following, I would argue. It's more of a niche following. It's more of a base following. They have a subscription. They're trying to build a platform with actually more than just BNPL. And they have secured credit cards, deposit accounts. They have an option actually where you can report to credit agencies for people trying to build credit. Shopping and engagement. They have discounts. They have insurance. It's mostly a BNPL platform, but it's a hybrid with like a savings app and a shopping app. They also launched AT&T partnership where they sell a phone division. Anyways, they seem to be taking a more bespoke strategy with a dedicated following, trying to have a dedicated following that keeps coming back to the Sezzle app. One of the aspects that Sezzle really does well is it seems to be really loved by its users. The App Store rating is 4.9. Again, this company really resonating with Gen Z, perhaps even more than Klarna. That would explain the valuation. Like, to me, of course, when I look at this, Klarna seems like the better deal. When I compare Klarna to Sezzle, it seems like a better deal. But you see, Sezzle has recovered quite a bit. Sezzle is up 50% roughly from the March lows, which is kind of like taking a different direction from, say, a Nubank or Klarna. So I definitely think Klarna and Nubank are better deals than Sezzle right now. But Sezzle, firing on all cylinders, really. I mean, revenue growth is up 29%. Net income is up 41%. See, there you go. You can explain a big difference in that valuation in that they already report net income, right? Klarna is a few quarters away from that. They're already there. So that explains why. And the market really excited, of course, about that Pagaya partnership. So when you have a new customer or BNPL, typically they'll take a risk on you on a loan for like $150 or $200. The Pagaya partnership allows them to do a starter loan at a higher amount. Right, higher amount than 150, higher amount than 200, and of course that would increase your revenue growth. And so they have this partnership with Pagaya. Pagaya, of course, being a credit decision system, a credit decision tool. Pagaya, another stock that is very cheap. As people who comment on my channel remind me all the time, it is very cheap. I know, I see it in my spreadsheet. It is very, very cheap. Pagaya is very cheap. Is Pagaya as cheap as a Klarna? No. It's not as cheap as a Klarna, but it is very cheap still, right? So anyways, people getting excited about that partnership. I think all three of these companies will do fine. I think all three of them are too cheap, but especially Klarna and Nubank are particularly looking cheap to me. I loved the Q1s. I like these companies very much. I think they are the future of finance. And I think they will do well going forward. So anyways, this is definitely not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.